Thank you, Rich, and good morning, everybody. I thought I would start with a very high-level overview of our upstream business. And as you know, we have a large, long-life, predominantly oil sands portfolio. We have our Cold Lake in situ asset, a cornerstone asset for us and a leading industry asset in many, many ways. We have Kearl, our next-generation paraffinic froth treatment oil sands mining asset, an asset because of that proprietary technology, we were able to go straight to market without an upgrader. Syncrude with an upgrader, an oil sands mining pioneer in many ways, and an asset where we have been an owner from the very beginning. And then we have what I called our remaining portfolio. We have our conventional later life assets, the largest of which is Norman Wells in the Northwest Territories. And you'll recall we restarted production late last year as the Enbridge pipeline repairs were completed. We also have a liquids-rich position, unconventional position in the Duvernay and the Montney. And of course, we also have an outstanding portfolio of future in situ opportunities that I'll talk more about. Collectively, we hold some 6.5 billion oil equivalent barrels of proved and probable reserves. And in terms of production, we're basically a 400 KOEBD producer, Imperial share. I'll talk a little more about our current performance as well as growth opportunities as we go forward. Before discussing our assets in turn, I'd like to touch on the upstream overall. I mentioned our 2P reserves. I would also highlight that we have a very high quality resource base and nearly 30 years of proved reserve life. And that excludes, of course, our probable reserves and our contingent resource. The next thing I'd highlight is that on this chart is how much our business has changed over the last 20 years. If you look at the plot and you go back 20 years to 1999, a large portion of our production came from unconventional assets. 50% was oil sands, and the rest from a broad range of unconventional assets producing roughly 50-50 oil and gas. If you fast forward 10 years to 2009, you'll see where 2/3 of our production was coming from oil sands. And move forward another 10 years to today, we're 90+% oil sands. 3 core assets, as you can see on the left, Kearl, Syncrude, and Cold Lake. Now that was a deliberate move, that was a choice we made in increasing our concentration on long life, high quality oil sands assets. But with that heavy oil concentration, 2 things are really important. Reliability is critical, and because we have 90% of our volumes coming from 3 assets versus a range of conventional assets. And we need deep oil sands knowledge and operating expertise. And we have laser-like focus on those 2 things in our business. Continuing with the upstream overview, on this chart, I'd like to provide a view of our production and cash from operations. As you know, our focus is on growing profitable volumes and cash generation. The plot on the left, you'll see our production over the last 9 years, 2011, 2019, and you'll notice significant growth in that volume post-2014 when we were producing about 300 KOEBD to where we are today at 400 KOEBD. And that growth largely driven by Kearl, partially offset by conventional decline in asset sales. If you look at the plot on the right, looking at cash from operations, the years and the time periods are the same. And you'll see a 2.5 annual average cash from operations in the 2011 to 14 time frame. WTI at that point averaged $95 a barrel. And cash generation was really coming from Cold Lake and Syncrude. As you move in the 2015 to 18 time frame, there was a big drop in WTI and WCS. And while our production was up in those years, our cash gen was down to about $700 million per year, driven by price. Now, very happy to say, as you look forward and highlight, look at 2019, we see our cash from operations at $1.3 billion year to date, and nearly double what we were seeing in the 2015 to 18 timeframe. We're seeing a couple of things at play here. We're seeing the response to price. There's no question. WCS is up about $9 versus the 15 to 18 period. But we're also seeing the benefit of higher volumes and improved underlying asset performance. Starting with Cold Lake, I'll now discuss each of our assets in turn. Our large-scale Cold Lake in situ operation has been the cornerstone of our upstream business for many years. And when you look at the 2P reserves on this chart, it will remain a core asset for many years to come. 2019 production through Q3 is at 141 KBD. That's a little lower than we've seen in recent years, and I'll come back and discuss that a little further. A few highlights I'd like to make on Cold Lake specifically. We continue to leverage our extensive 4+ decades of experience, and the asset continues to evolve and improve. The application of new technology has always been and remains to be a key to Cold Lake's success, and part of that technology is the use of solvent recovery techniques to lower costs, to improve environmental performance and maximize recovery. I'd also highlight that we restarted our drilling program in 2018 after a couple of years break, and steam in from the first pads was the first quarter of this year, and we are now starting to see volumes uplift from that program. Looking a little closer at Cold Lake performance, our focus has remained on life cycle optimization and cash generation. That hasn't changed. And this is an asset that has performed extremely well for us, and we continue to see strong base operating performance. But we are having some challenges with Nabier that will see our overall production in the range of 140 KBD for the next 2 or 3 years. As mentioned, our focus is on maximizing life cycle return and recovery, and we have 3 key focus areas in that regard. The first is on optimizing steam distribution. Steam is critical for bitumen recovery, and it needs to be available, and it needs to be deployed to the right part of the reservoir to improve and maximize recovery, and our team does a really good job of doing that. Fully utilizing our existing wellbores. We got 5,000 wellbores at Cold Lake, and they need to be taken care of to make sure we can maximize recovery. We have a very active well work program looking at the integrity and the reliability of those wells, and that is the most profitable work we do. And then near-term capital-efficient opportunities. I'll come back and talk about Grand Rapids development in more detail. That's a key part of it. Another key part of it is the drilling program that we restarted in 2018. That is contributing about 2 KBD in volumes this year, 5 KBD next year, and we see ourselves continuing with that drilling line for the foreseeable future. So looking at the plot, you can see the 140 KBD range in the 2020 to 2022 period, and then rebounding to 150 KBD when we get into 2023. Now, in terms of unit cash, what that's going to mean is we're probably going to be in the $14 to $15 a barrel unit cash cost 2020 to 2022 until we get the volumes back up and get the asset back to $12 to $13 a barrel range. But at the end of the day, Cold Lake remains positioned for strong cash generation in all business cycles. So in discussing Cold Lake's forward development plan, I want to acknowledge Nabier's performance. Very careful analysis of Nabier's results has been applied to all of our go-forward development plans, and I'll talk about that. But we have had some issues with Nabier reservoir performance. And I'd like to describe those. You can see where Nabier is on this chart, and it's quite a distance from the kind of heartland of Cold Lake, which is around Masquaw, Lemming, and Maquisas, and Mohican. And as we moved out into that area, we moved into a thinner reservoir. And we knew that. We knew it was going to be thinner. And our expectations were tempered appropriately for going into that thinner reservoir. That said, our pads have not always been able to produce what we had predicted. And that thinner reservoir is behaving a little differently than we had expected as well. In addition to that, the wells have required very careful steam management due to the potential for steam excursions into a shallower reservoir. And these 2 things have resulted in reduced steam injection volumes and shorter steaming cycles to manage the reservoir and to manage the cap rock integrity. Now, there's not an integrity issue here. The team is managing that very well, so there is no integrity issue per se, but the net result is lower production and more well interventions than we had expected. And the production is about 10 to 15 KBD below our original expectations at this point in time of the life cycle. Stepping back from that though, despite the challenges at Nabier, it's still adding value to the asset. For example, our year-to-date cash generation from Nabier alone is about $100 million. The steam plant facilities are efficient and they are high-performing, and we've then now internalized all of that learning and applied it to our future development plan. And I'll explain a little bit of what that means. I would say we've learned a great deal as we've gone through the Nabier experience, including more about the different relative geologies across the field. And a couple of things that we have changed is our well spacing. We've reduced our well spacing at Nabier and at Mohican, and we've continued to optimize our horizontal well designs. We drilled the first horizontal well in 1979, and we continue to improve on that. Those two things are critical, and those learnings have been applied, and we're seeing positive results from those. But the team has also stepped back, and we looked at the complete overall development plan for Cold Lake and retested what is the highest and best use of steam capacity. And going through that, an opportunity has come to the fore, an opportunity where we can use the excess available steam at the Nabier plant to develop the Grand Rapids Reservoir. We will use steam from Nabier to develop that reservoir in a very capitally efficient manner. And if you look at the chart here, I've highlighted the locations of the Grand Rapids Reservoir. This is a shallower reservoir. You can see in yellow is the first phase of that development, and the green outlines are the future developments. So it's a sizable resource and a sizable reservoir for us. If I talk a little bit about that Grand Rapids, what it's going to be. Well, it's going to be industry's first solvent-assisted, steam-assisted gravity drainage, SA-SAGD commercial development. And if you look at the chart, you can see what that is. Wells are going to be developed in horizontal pairs with solvent and steam injected into the injector well. Bitumen viscosity is lowered and heated, and the bitumen flows back through the production wells. In addition to being a highly attractive project, SA-SAGD is also an environmental improvement over the base CSS pads, providing a 40% reduction in greenhouse gas intensity. And as I stated earlier, this is the first development into the Grand Rapids Reservoir. The Cold Lake is historically produced from the Clearwater Reservoir, which you can see on this chart. The Grand Rapids is the shallower of the two reservoirs. Now, we're planning to develop this in 3 or 4 phases over a fairly long time horizon. And what that's going to enable us to do is use existing facilities, de-risk future phases, capturing and applying lessons learned, and optimizing across all of Cold Lake the best use of our available steam. The first phase will start drilling in the second quarter of next year, and we plan to start up in late 2021. Average production from this very first phase is 15 KBD at a cost of $450 million. And on a really positive note, our regulatory approval is in place and the project is ready to proceed. Let me talk a little bit about, our confidence, what supports our investment confidence in this Grand Rapids development. As we move into this, we're going to be drawing on a very deep bank of knowledge and experience, and that supports our investment confidence. The Grand Rapids Reservoir has been characterized through 2D and 3D seismic, through delineation drilling, and well data like cores and logs and pressures and so on. And we've collected that over time as we've developed the Clearwater Reservoir and as we had an eye to developing this Grand Rapids potential as well. We then have a comprehensive reservoir simulation model that integrates all of that data, surface data, laboratory tests, analog studies, and field trials, and so on. And what we've been doing is studying, other in situ operations, including 2 directly in the Grand Rapids, coupled with our own reservoir engineering understanding to forecast the performance outcomes for Grand Rapids. The simulation and analog work that we do in the studies, that's done in an iterative loop, and that enables us to hone in on the best well designs, the best spacing, the best solvent concentrations, and so on. Imperial is a leader in laboratory testing. We have our own lab, our own research facility, and our physical model experiments have allowed us to recreate a representation of the Grand Rapids Reservoir, and that's what you see on the top left of this chart. Those are our physical models in our lab in Calgary, and we use those to kind of put that representation of the reservoir together. We can change factors like bitumen saturation, pressures, and solvents in there and get results in a matter of weeks and months versus doing it real time over years. And then we have our multi-year pilot. We've had an SA-SAGD pilot at Cold Lake since 2009, and that gives us direct operational experience in terms of the technology. So we take all of that, the 3D seismic, our delineation drilling, our computer, our analog analysis, lab testing, pilot testing, put it into our simulation models, and that work is what's giving us high confidence in this investment opportunity. Now, I think you probably picked up from all that, the Grand Rapids Reservoir is a really key part of our Cold Lake development strategy. It has been. We knew this day was coming for a long time. But building on that, I tell you, I'm really excited on how it improves upon our previous development plans and how the project fits on their strategy of maximizing asset value. The development plan for this resource, and we talked about this at the Investor Day last year, was originally planned through our Cold Lake expansion project, which would have required construction of an additional Navier-scale steam plant and a significant upfront cost of about $2.4 billion. That development would have ultimately delivered about 50,000 barrels a day, nominally starting up in the 2030 timeframe and running for 30 years. This new approach that we've taken, the Grand Rapids phase development, will capture the same resource through smaller phased developments. The individual phases will use the steam from Navier and then other Cold Lake plants as it becomes available. And it's more capitally efficient in terms of the savings is $1+ billion of lower capital costs. And it depends a lot on your time frame because of this phased approach. But if we look out 20 years, we look out to 2040, and we look at the cost of this versus Cold Lake expansion, the savings at that point in time would be about $2 billion less capital spent over the next 20 years. So capital efficiency for the Cold Lake expansion project, that was about $40,000 per flowing barrel. This one we see as being something less than $30,000 per flowing barrel. So to conclude on Cold Lake, if you look at the chart at the top left, Cold Lake's been in operation for 4+ decades. We've only produced about the same amount as we currently have remaining in terms of proved and probable resources. So clearly Cold Lake's going to be a big part of our portfolio for many years and decades to come. Due to the challenges I mentioned at Navier, though, we will be currently producing about 140 KBD. We see that being the case for the next 2 or 3 years. But through the development of this Grand Rapids reservoir, the maintenance of our drilling and well work programs, and applying the right technology, we see it returning to 150 KBD, and we're relentlessly focused on that and doing that by 2023. Table at the bottom left really shows how this new technologies and the asset has evolved. If you go back to 2000, it was 100% cyclic steam stimulation was how we developed Cold Lake. Look at it today. Slightly less than 50% of our volumes are from CSS, slightly less comes from steam flood, and you can start to see a small wedge of solvent recovery at the top of that bar, and that's our laser development that we've kicked off. We look out another 10 years or so, we see a much more balanced input from CSS, steam flood, and our solvent recovery technologies. Overall, objective remains the same, maximizing long-term cash generation. Syncrude. A true pioneer in the oil sands mining business, first production in 1978, over 40 years ago. And just recently, on October 18th, the asset produced its 3 billionth barrel. And that's gross, so for our share, 750 million barrels imperial share. And again, if you look at the 2P reserves, we have about 700 million barrels of 2P reserves remaining. We're really proud to have been part of Syncrude from the very beginning, only original remaining owner, and feel very positive about the future that Syncrude has in front of it. A few aspects around this asset. The upgrader produces a high-value synthetic crude that's historically traded within a few dollars of WTI. Reliability continues to be key in improving overall performance, and that is getting the full attention of Syncrude leadership and the Syncrude owners. And we're starting to see some encouraging results. If you look at the year-to-date production through Q3 at 76 KBD, and you may recall last year for 2018 it was 62 KBD, so we are starting to see some improvements there. Overall, though, and what I'll outline in the next page is our focus is still on further improving reliability, developing additional resources, and leveraging the owner's strengths to make this asset the best it can be. As I mentioned, we are seeing some encouraging results as we've continued to focus on and sustaining our reliability improvements through our multi-year plan and all of the hard work that's gone on over a number of years. I would say we continue to have high confidence in the reliability improvement plan and the progress we're making, and it is meeting our expectations. Our focus remains on eliminating one-time events. We spoke a fair bit about that last year and how that was limiting the potential of the asset. If you look at the chart on the left, I'll highlight a few things. First, we remain committed to an annual production target that's 75 to 80 KBD, our share, and you can see that by the gray band. Second, if you look at the prior 4 years, you can see the impact of these one-time events, a significant event each year over those 4 years. That's the dashed white box on the top of the bar there. And you can see without those one-time events, we would have been at our target production. But they did occur, they're part of our reality, and we're focused on learning from those. Ongoing reliability improvement is focused on a few key things: mechanical integrity, like piping upgrades, turnaround planning and execution, optimizing our tankage, for example, and then leadership and workforce development and collective competency. We've had a very collaborative approach with all of the owners and have been sharing best practices, allowing us to learn from each other and improve Syncrude. If you look at positive performance trends, kind of how things are going, I think we've had a number of them. Obviously, the volumes year to date is a key piece of it, but our last 12 months through Q3 of 2019 has been the best 12-month production in the asset's history. It's been at 80,000 barrels a day, the top of our range, and we've had 4 monthly records in that period as well. So going forward, we look to eliminate one-time events, get the utilization of our upgrader up in the 90% range, and achieve best-in-class performance. Our goal remains to get the asset to $30 per barrel US, all in on a cash OPEX basis. Consistent with our view of Syncrude's future potential, I'd like to talk a little bit about the Mildred Lake mine extension, which will sustain 40 plus KBD of production for Syncrude. As you can see on the map on the left-hand side of the screen, the project is really a natural extension of the existing Mildred Lake North Mine, as the North Mine is going to be depleted in the 2027 timeframe. It will extensively leverage existing mine infrastructure and support an additional 10 plus years of mining operations. Gross project cost is $1.5 billion, going to be spent in the timeframe between 2020 and 2024, more back-end loaded into 2023-2024 timeframe. Captures some 540 million barrels of resource with a very attractive development cost, about $3 a barrel, and first ore in 2024. So extension really enables capturing this reliable low-cost source of bitumen to maintain our current rates. Regulatory approvals are in hand, and the work has already started to support 2024 first oil. If we look out to 2027, the Mildred Lake expansion will support about 50% of Syncrude's total production. You know, our goal through collaboration is to leverage all of the owner strengths and continue to accelerate performance improvement at Syncrude. Over the past few years, we've seen ownership consolidation at Syncrude. Today, 80+% of the ownership is held by companies that have oil sands mining experience, namely ourselves and Suncor. And all of the owners have oil and gas industry experience. So that really offers Syncrude the opportunity to draw upon the expertise, the services, and the personnel from owners. If you look at this chart in the very background of this, you'll see the proximity to Suncor's base mine. You can kind of see it in the background there. That opens up the opportunity for regional sharing of services like warehousing and camps. Those items are being worked very hard, and some of them are already in place today. The other thing is, of course, owners can provide business services in IT, procurement, financial services, and so on. Things that we've been providing over the last decade through the management services agreement. But as we've looked at this and collaborate with Suncor and given their larger ownership position in the 60% range, we're going to be starting to transition those services to Suncor provided. And that just makes sense given their ownership and given their proximity to the asset. At the end of the day, we're just continue to work with the owners to find the way to make Syncrude as good as it can be. We'll continue to provide significant technical support in terms of the reliability improvement support, upgrader technology and expertise, and best practice sharing. So we continue to be very heavily involved in this asset. Beyond that, I think there's a lot more opportunity out there in terms of the performance. And an example of that is 2 interconnecting pipelines that are going to carry bitumen and sour synthetic between Syncrude and Suncor. They've been approved, commercial agreements are in place, construction has started already, and that's going to allow the movement of intermediate streams between the Syncrude and the Suncor upgrader, allow bitumen to move back and forth between the 2 upgraders to maximize upgrader utilization. It adds value for both ventures, and it'll start up at the end of next year. I would say that's an opportunity that we just cut our teeth on. We see a lot of opportunity as we look at how we work together and collaborate to drive performance improvement overall at Syncrude, and we're very positive about Syncrude's future. Kearl. Really excited to talk to you today about Kearl. I've been working on Kearl in a pretty significant way for the past 7 years, and while I've always been super confident that this asset and our team would deliver on expectations, I probably wasn't always excited to talk about it. There were some challenging times, but we've come a long ways. We refer to Kearl as our next generation oil sands mining operation. That refers to our paraffinic froth treatment technology. And a result of that technology, as I mentioned earlier, we're the first oil sands mine able to sell our product directly to market without upgrading. It reduced our capital investment, and it places our wells to wheels greenhouse gas intensity of Kearl on par with the average barrel refined in the U.S. today. PFT essentially strips out the heaviest, lower value parts of the barrel that would have the highest greenhouse gas intensity to process, and we put it right back in the ground at Kearl. Now with Kearl, we also have Mother Nature on our side. We have a large, high-quality resource that will produce for decades to come, and we're focused on continuing to improve Kearl's performance, meeting our production commitments, and on near-term production growth. We looked at Kearl as an organization and saw this as our single biggest challenge, a corporate-defining opportunity, and the whole organization has been seizing this opportunity. And we've started to demonstrate what Kearl is capable of with 206 KBD last year and 204 KBD through the third quarter of this year in line with our commitments. And we see significant profitability opportunities as we look forward. When it comes to Kearl, we're focused on each and every element that drives asset performance, most notably profitable production growth, cost structure, and realizations. And in our drive to make Kearl all it can be, we've leveraged our full organization, and that focus is really focused on improving Kearl performance and growing cash generation capacity and delivering on our production commitments. And we've done that, and we have further opportunities, a broad range of opportunities to increase the value of the asset. Now, a large mining operation like Kearl, it does need some care and feeding, and in that regard, we see sustaining capex to be in the range of $5 per barrel Canadian. And in terms of unit cash OPEX, our target remains unchanged. We are looking to drive our all-in unit cash OPEX to $20 a barrel US. Now, unit cash OPEX can be represented in many different ways. So to clarify what I mean when I say all-in, I mean it's fully burdened with overhead and corporate costs, controllers, research, IT, HR, parts of my salary, and that of my colleagues here today. So fully loaded cost. The chart to the left, you can see what we're trying to do with the asset and what we have been doing. If you look at 15 to 17, the asset was producing about 165 KBD. 18 and 19 were just north of 200 KBD. We go to next year and the year after, the asset's at 240 KBD. I'll talk a little bit more about that. And then ramping up from there till we get into the 2024 plus timeframe at 280 KBD. And over that period, also improving our base cost structure, and all of that is what gets us to $20 a barrel. Let's look at the pathway now to achieving that cash cost of $20 a barrel. And I'll discuss each of these things in detail, but before doing that, I want to highlight and illustrate the major components that lead us to that goal. Starting on the left of this chart, the unit cash you see here represents Kearl's unit cash in 2018 and 19 when we're producing around 200,000 barrels a day. As you're well aware, we have our supplemental crusher project ongoing for startup late this year, and that project will allow Kearl to produce 240 KBD, and with the crushers online, you can see the reduction in unit cash as represented here in the waterfall. Then the next is a series of mine and plant improvements, which will allow us to further unlock production volumes as well as cost reductions through a variety of small and mid-sized projects. And that will contribute an additional unit cost reduction, as you can see. Another key component is moving to autonomous haul trucks. We've shared this in the past. I'll talk a little bit more about it again today. The opportunity continues to progress, and we're seeing a unit cost reduction from staffing and productivity improvements. Digital, that remains as a transformational program for our operations, finding ways through digital to complete work and optimize operations to reduce costs and enhance volumes. We're taking action to be a leader in digital and artificial intelligence, and we also see that as a contribution to getting to $20 a barrel for Kearl. You put these four things together, that's what gets us, that's the pathway that we're following. And I would say from a cash gen perspective, when we look at this, it'll improve our assets, cash from operations, something north of $500 million a year. Let's start with the supplemental crusher. Really excited about this capital efficient addition of 40 KBD annual average production in 2020. The investment involves adding supplemental crushing capacity and surge bin feed conveyors and installing hydrotransport line interconnections. If I'll draw your attention to the chart, you can see the project is adding an extra crusher and at each existing plant, as well as associated feed conveyor system. You see that in blue. And then in terms of the hydrotransport interconnect, it adds equipment that connects 4 slurry lines, and this allows combinations of lines to feed either plant. These will allow planned maintenance to occur in this part of our facility without any impact to volumes, and will mitigate the effects of unplanned reliability events. This project is going to provide a step change in reliability for us, cutting our current scheduled and unscheduled downtime in half. In terms of cost, it's a $600 million gross investment, and from a capital intensity perspective, a very attractive $15,000 per flowing barrel. And it truly is foundational to improving Kearl's profitability, and on target to start up at the end of this year. On this chart, the photo you see in the background is the K1 supplemental crusher. You see it's in the foreground of the picture, and it's going off the right up what we call a ski slope into our surge bin, and then on the very back on the right is the existing crusher. So as you can see, things are progressing. We're going to show a video over the break that you'll see a little more detail of this and some drone captured views that's worth a look. Overall, project's nearing completion. Project group is deep into commissioning and handover to operations for startup. Our operations readiness team's been diligently working on operations and maintenance plans, startup sequencing, staff preparedness, and so on, to make sure that when this starts up, we have our people, our processes, and our equipment ready from day one to meet our goal of 240,000 barrels a day. As we look at 2020, we expect a seasonal production profile similar to what we've traditionally seen at Kearl. If you look at the chart here on the left, the first quarter expected to be in the range of 200,000 barrels a day, as winter operations are traditionally our lower production periods, and the project is ramping up to full rates. Second quarter, we see production about 240,000 barrels a day, better operating conditions, lower downtime, somewhat offset by the start of our turnarounds, and at this stage, the crushers are fully ramped up. Third quarter, traditionally our highest production months, we are anticipating new high water marks for Kearl as we come into the summer, well north of 240 KBD. Fourth quarter, we do have some turnaround impacts again coming in there, but we see the asset producing above 240 in the fourth quarter, and net that gives us our 240 KBD annual average for the year. The next step that I talked about on the waterfall, we're looking, of course, beyond 240 KBD, and we have a series of targeted mine and plant improvements. We see a pathway to 280,000 barrels a day, and nominally thinking, as I mentioned, 2024 plus, with a ramp up occurring in 2022 and 2023. If you look down this list of opportunities here, what I'd point out is that we have opportunities to span the whole kind of portion, all of Kearl, from the resource through mining or preparation, extraction, froth treatment, and on to market. I'll start with enhanced mine planning. There are many aspects of this, but what it's really all about is resource selectivity, and the benefit of that is feed stability and overall bitumen recovery improvements. A small example of that is we moved to using more hydraulic shovels versus the electric shovels. They're smaller, they can be more selective, and they can dispose of thin layers of waste, and we put them in our overburdened disposal areas versus running them through the plant and reducing our recovery. That was one example. I'll share an even more material example on the next page. Primary separation cell upgrades. We're basically enhancing the materials, enhancing the design so that we can lower our SDT. Right now, we have each of our plants are down for a major turnaround each year. So we have 2 major turnarounds each year. This work is going to get us to where we have just 1 major turnaround each year, and that adds about 8,000 barrels a day in terms of our production. Secondary bitumen recovery enhancements, that's around our flotation cells and enhancing bitumen recovery there and reducing maintenance costs. We have froth treatment enhancements where we can make connections between our froth plants to improve on our reliability. and improve volumes and reduce cost as well. Diluent and solvent utilization. Example of that is we are now moving to a supply of solvent from our Sarnia refinery. We've typically bought our solvent from third parties in the Gulf Coast, and that provides us integrated value as well as security of supply. Diluent, that is a cost for us when we had to put diluent in to create dilbit, and we're looking at reducing the amount of diluent we need to use through trim blending and shipping a higher viscosity product. And some of those projects are underway already. I look across this full slate of opportunities and our path to 280 KBD. I feel very good about the opportunities we have. We're progressing them all. They're in various stages of maturity. But at the end of the day, the capital intensity of this is similar to the crusher project that I mentioned earlier. Let me provide a kind of a more material example of what enhanced mine planning is all about. On this page, the photograph you see here is our K1 ore preparation plant, or our OPP. And as you can see, it's an extensive facility. The components include the crusher, which is off to the far left. You can see kind of a yellowish orange color there. That's where the trucks load the crusher. And then you run through a series of conveyors up to a surge bin, a 10-story structure that you see, slurry prep plant, and all this spread over some 750 meters. So a very large, complex facility. Now, there's oil sands resource below this ore preparation plant. And our initial plan, based on the regulations, was that we would build a new ore preparation plant. We'd remove this one, and then we'd mine underneath it. And the cost to build that new one and remove it is somewhere between $1.5 and $2 billion. So we ran all this through our mine plan value model, and that takes into account infrastructure and the amount of resource and everything else. And the result of that is the most optimal thing to do is actually leave this OPP place and not mine the resource that's underneath it. We worked with the regulator, very constructive engagement with the regulator, and received approval in April of this year not to build a new OPP and remove this one. The cost overall of this would have started in 2025. Now, we have to do a few new things. We're going to leave this OPP in place. We got to build a couple of new conveyors and things. But overall, this is going to reduce our capital by about $1 billion. There's 100 MOBIs or so we won't get, but when you look at it, that's a value accretive decision. Mining's a long-term business, and we needed to make a choice like this now so we can plan and execute our mine advances in the most cost-effective manner. And I'll tell you, we are continuing to look for more opportunities like this. Autonomous haul trucks. As you know, we're partnering with Caterpillar and Finning, and we have an autonomous haul truck pilot ongoing. Our ultimate goal is to convert our fleet to autonomous to improve profitability and improve safety. We've been working on this for about 4 years. We've had autonomous trucks in service since 2017. We currently have 9 trucks in service, plan to be at 12 by the end of the year. And they're in productive service. I mean, they're doing real work. They're not just in a kind of ring-fenced area moving, product from one place to another. They are actually in our service. We have about 65 trucks, and we can't afford to have 10 of them just doing this without being productive, and they are. We're continuing to look at a range of conditions, soft underground conditions, temperatures, and things. The advancements have been very positive on the technical side. We've made software improvements that improves the operability of the autonomous trucks. On the operational side, as the team builds skill and confidence to get the most out of the system, and we've moved this now where the trucks are actually dumping ore into the crusher and offloading. If we look forward the next couple of years, we see ramping up to 20 trucks, upgrading to a new mine operating system that will support an autonomous fleet, and post-2021 be in a position to make a final investment decision. In terms of the reduction here between 50 cents and $1, and that comes from increased truck utilization, productivity improvements, and reducing staff. We need about 5 FTEs per truck today, and this is going to bring it down somewhere between 1 to 2 per truck. I say all that in terms of, we are contractor leveraged right now so that we can do this without layoffs in our workforce. It's just going to be new and different career paths for our team, and we're working very closely with the team, and they're quite excited about this and been heavily involved in the training and the technology proving that we're doing today. We target full conversion by 2023. Kearl outlook. Been a tremendous journey in recent years. Very excited and enthusiastic about improving financial and operating performance that we've seen in recent years and about the future. Last year's production commitment, 200 KBD, we exceeded that, and so far this year, above 200 KBD as well. So really showing a new baseline for Kearl. Next year with the supplement of crushers getting to 240, and then through this series of mine and plant improvements to 280,000 barrels a day, all driving towards a unit cash goal of $20 a barrel, and to make Kearl the safest, most reliable, profitable oil sands operation in the business. And all of that in terms of maximizing long-term cash generation, of course. I'm going to move a little bit away from oil sands for a moment and talk about our unconventional business. When we think about the unconventional portfolio we think about the optionality it provides us. It offers us a liquid-rich opportunity, but we're taking a very paced development approach. We are 50-50 owners in this with ExxonMobil, and we hold acreage in the Montney and the Duvernay. When we look at this against U.S. unconventional plays, it looks quite competitive. That said, we need to learn more about the opportunities and how it fits into our portfolio. And the other thing I'd mention is, we're leveraging everything ExxonMobil has in this space and their unconventional knowledge and their practices. We're not reinventing the wheel in any way, and we have a relatively small team working on this optionality. Our initial development in the Duvernay is now complete, and it's kind of in a sustainment mode. That initial development was largely designed to, maximize the processing capacity of our existing gas plant. And you can see that in the picture here. It's an expanded compressor facility, developed the highest quality resource, about 100 MOBs, and about half of the acreage position that we had, and overall develop and deliver 25 KOBD of gross volumes. In terms of the Montney, we're not so far along. We're focused on the very, very best liquids resource areas and retaining just the highest quality resource base. Investment-wise, we see about $100 million a year of investment, and that's going to drive our volumes to 20 KOBD in 2020 versus 13 in 2018. So very paced approach, provides significant long-term optionality, but we're going to need to learn more to see where this all fits in our portfolio. What we're pretty clear does fit well into our portfolio is our large inventory of top-tier opportunities. We believe very strongly that in situ is our future, and we believe we have what it takes to win when we look at the resource quality, the technology, and the experience we have in this space. We've been in the in situ game for many years with Cold Lake and through our research, and that depth of experience and technology will be applied and fully leveraged. We plan to use, and we've talked about this before, a design one, build many approach, which will allow us to apply lessons learned in both project development and operations. Table at the bottom right highlights our in situ portfolio and current progression towards development. We have high quality projects in all stages of development, from assessing the resource all the way through to regulatory approval. I've talked about Grand Rapids Phase 1 already. Of course, we have Aspen, and I'll cover that on the next page. And then we continue to actively gather data and advance this portfolio to make sure we have flexibility and develop these in the right sequence to maximize value. And an example of that is we're going to be doing a seismic program at Clark Creek this winter. Beyond the volumes potential in these in situ assets, coupled with our technology, they offer lower development cost, lower unit cost, and lower greenhouse gas intensity compared to currently producing in situ. And to give you a feel for that, really bring it to life, I'll just do a couple of, compare Aspen to Cold Lake. Now, we know how strong Cold Lake is and the cash that it generates. It's an asset that's very important to us. But if I look at Cold Lake, when it's at 150,000 barrels a day, and Aspen produces 75,000 barrels a day, so about half the size. Cold Lake has a workforce, a direct staff of about 400. Aspen will only need 70. Cold Lake has 5,000 wells. Aspen will have 84. Cold Lake's unit cost at 150, $12 a barrel. Aspen's $6 a barrel. And greenhouse gas intensity, 60% less than Cold Lake. So for as much as we love Cold Lake and how important it is to our business, this in situ portfolio can be even better, significantly better. I would just say right now, though, the timing is uncertain, and I'll cover that a little bit on the next page. So you're all very familiar with our Aspen opportunity and development, where we will use SA-SAGD, provide economic and environmental benefits. You recall the initial capital was $2.6 billion, and delivering the 75 KBD, as I just talked about. To me, it still remains a cornerstone of our future in situ plans. And the question is not if, but rather when will the Aspen project move forward. As communicated before, we've slowed the Aspen development as we evaluate the investment environment in Alberta and in Canada. And you can see here on the page the considerations that we are looking at in terms of when we return to planned activities. Curtailment in Alberta remains in place, and to invest in new development like Aspen, we require curtailment to be eliminated, providing confidence in being able to fully operate and produce the asset. In hand with curtailment being eliminated, we need to see positive economics in crude by rail. They're important to our future development and long-term economic health. You're aware of the market access situation and constraints, and we'll need to see some progress in terms of pipeline egress options. And finally, we're going to need to see, in confidence in general market conditions. We're seeing some positive things provincially in Alberta, for sure, in that regard, but overall, more is required. So we continue to watch those signposts closely and watch the progress in the status, and that will determine when we return to planned activities. Overall, though, we remain committed to Aspen, to the in situ portfolio. We have a great resource, strong economics, and we have the right technology to unlock the full potential. There's no doubt in my mind that Aspen is going to be a key 75 KBD tranche of our production when the timing is right. Let me talk a little bit about technology and innovation. It links closely to everything we've talked about up to now, and together with our people, it underpins all we do and is key to our future success. We have demonstrated an unparalleled commitment to technology and innovation and achievement through our 139-year history. Looking back at the last 20 years, we've invested more than $2 billion in technology in good times and not so good times. And Imperial is one of corporate Canada's largest investors in R&D. If you look at the timeline here, you'll see a series of key accomplishments. Canada's first petroleum research department in 1924, almost 100 years ago. CSS patent in 66, SAGD patent in 79, paraffinic froth treatment patent in 2015. In fact, we hold active patents in many in situ technologies, including laser, eBERT, and CSP. We hold about 1,000 patents right now. We've upstream and downstream research centers, Calgary with our focus on upstream oil sands and environmental technologies, and then at Sarnia with our focus on downstream petroleum products research. And you can see a picture here towards the bottom right of the page of our upstream research facility, 4,000 square foot facility, 45 researchers, half of them with PhDs, focused on the next frontier of oil sands technology and performance to lower costs, improve performance, reduce environmental footprint, and unlock resources. And we get the full advantage of ExxonMobil's research as well, and they're doing extensive research in refining and fuels, reservoir modeling, and of course things like carbon sequestration and biofuels. At the end of the day, I would just say, technology is in our DNA. Moving specifically to our in situ recovery technology, these technologies drive economic and environmental performance improvement. If you look at the chart on the left, you can see our full suite of technologies. They're really, what we'll use will depend on the asset, what the asset needs, the depth of resource, the quality of resource, the stage of life, and so on. You can see our cyclic technologies for deeper kind of pressures, like in Clearwater at Cold Lake. And then lower part of the plot, you can see lower pressure continuous applications for things like Grand Rapids and the Athabasca, like Aspen and the in situ portfolio that I just spoke about. And you can see a range of applications from 100% steam to basically 100% solvent. Moving to the plot on the right, we have in-house developed all of these technologies that you see on here, with the exception of SA-SAGD, which we developed in a consortium. And we continue to advance these. I talked about the SA-SAGD pilot at Cold Lake. We've been running a CSP pilot at Cold Lake since 2014, and we just received regulatory approval for our eBERT, our enhanced bitumen recovery technology, to start a pilot on that technology as well. So standing back, you look at these technologies, they will deliver a reduction in capital intensity and lower greenhouse gas intensity well below today's industry average for in situ. Technologies are going to enable us to keep Cold Lake profitable for decades to come and enhance the profitability of our in situ portfolio, all while lowering water and greenhouse gas intensity. I want to round out the discussion on technology and innovation talking about digital transformation. You've seen several examples today on the size, the scale, and the scope of our operations, and some of them I've laid out, and you can see them on the chart here. Those attributes provide an ideal platform for digital technologies. And as mentioned last year, we see a huge opportunity to reduce costs and optimize production recovery and improve reliability, with a value potential greater than $500 million per year. And as such, we're taking actions to be a leader in digital and artificial intelligence. We have a collaborative cross-functional team, business and IT resources led by our digital transformation manager together with our head of data science, and we are making digital projects a reality today. In September, we announced we are partnering with the Alberta Machine Intelligence Institute, a research institute that performs advanced research in fields of artificial intelligence and machine learning, and they're called AMI. AMI will help us enhance our capabilities in this space as well. You know, an important part of digital is realizing the value is creating the foundation, and that connects equipment, assets, and people. And this allows remote teams to support the assets, and it allows our operators to be digitally connected when they're in the field. And the top right are the examples of the foundational projects that we have already completed. And then we're leveraging digital for safety benefits. I've talked about autonomous haul trucks. And another example is the use of drones, where geologists can access mine data and visualization without actually being in the mine. And we'll have a video on the break on that as well, and the work we're doing with SAIT and the University of Alberta's Institute for Oil Sands Technology. Next areas and projects we have underway is around production and cost optimization, steam flood optimization at Cold Lake utilizing machine learning and advanced analytics, predictive maintenance using analytics to know when predict failures and know when is the right time to do our maintenance, and then workforce deployment through real-time data. And you look at this at Curl. We have a large workforce, a large volume of work. It helps us schedule some 50,000 weekly tasks and thousands of people to maximize time on tools. And like our other research, we know we're fully leveraging our relationship with ExxonMobil and technology partnerships they have with Microsoft and others. Digital, broad range of opportunities, projects being progressed, value potential greater than $500 million per year. Let me come back to how we get all our product to market. Market access, clearly a challenge for the industry. And when it comes to placing equity crude, our focus is on providing flexibility to place crude in markets that maximize realizations. And as the head of upstream, I don't worry about where the value is realized. It's in the upstream or the downstream. It's only how we maximize imperial value overall for the shareholder and get full advantage of our integration. And this chart describes how we do that. If you start at the top, we're again 400 KOEBD producer. We have about 25 KOEBD from conventional and unconventional business, mix of natural gas and light liquids, variety of disposal points. Then we have Syncrude at 75 KBD. Vast majority of that gets consumed in our own system, primarily at Strathcona. And we're left with 300 KBD between Cold Lake and Curl. And that equates to about 400 KBD of dilbit when we add the diluent to lighten it up. And we utilize 4 different clearing mechanisms to get that dilbit to market. They can vary over time. In the past, they've been roughly equally weighted. When we talked about it last year, they were about 100 KBD each. But if we look at curtailment has caused this to move around a fair bit. It's been dynamic, and the chart now describes where we see our placements. 60 to 100 KBD to Imperial refineries, 100 KBD on contracted pipe to the Gulf Coast, and then the remaining 200 split between rail and head of pipe. The ranges in blue really show the flexibility that exists within our logistics systems, and in particular, our ability in terms of the amount of heavy crude we put into our refineries. We can dial that up and down, and then leveraging our rail terminal to maximize value. Clearing mechanisms, they're generally speaking shown from left to right, starting with the highest value on the left and moving to progressively lower value options. The highest value barrels are the ones we run through our own refineries, where we get where the light-heavy differential is captured by the downstream. Next, we maximize what's transported and on contracted pipe to the Gulf Coast, where it captures U.S. Gulf Coast heavy adjusted for quality less the transportation cost. And finally, the remainder is either sold via rail to the U.S. Gulf Coast or at head of pipe. Current environment has been very dynamic. We constantly assess the market conditions, and we have had a range of everywhere between 0 KBD to 90 KBD going through our rail terminal on a monthly basis this year. Year-to-date average is about 50,000 barrels a day through the rail terminal. I'd say when we step back from all this, we look at the optionality. We're happy with the integrated position, the choices we've made. Mandated curtailment has changed the economics around crude by rail, and we do want to see an environment where rail is back in business and curtailment ceases. But despite all that, these choices were made looking at our business growth, our market conditions, our transportation risk, and we're happy with the choices we've made. And we ultimately have a lot of options, and we don't have any issue getting our product to market. So to wrap things up for the upstream, let's take a look at the near-term production outlook for 2020. As discussed earlier, our growth is underpinned by capital-efficient projects and reliability improvements. We expect to see volumes increase by about 6% from 19 to 2020, with a forecast in 2020 of about 420,000 barrels a day. I described Cold Lake as flat in 2020 versus 2019 at about 140 KBD. Improved reliability we've seen at Syncrude this year, we expect to continue into next year. Then, of course, Curl with the supplemental crusher moving to 240 KBD or 170 KBD IOL share. That really brings me to the end of the upstream material. I would just say, we're excited about the upstream business, the opportunities we're progressing, the value for cash that this part of the business generates, and I hope this provides you with some insight into our upstream business, our strategy, our approach, and the growth we see going forward. I'll now pass it back to Dave. Thank you.
Okay, we're going to take a short break now. As John mentioned, we've got a couple of videos we're just going to loop over the next 10 minutes. Feel free to watch. Otherwise, please be back in about 10 minutes. Thanks.
CIRRUS is the Centre for Innovation and Research in Unmanned Systems. Our mandate or our role, or one of our main parts of our mandate, is to actually partner with industry to become an enabler for them to adopt new technologies, to help them develop applied research challenges which involve drones in one form or another.
The project, which we call the UAV project, and so it's a collaboration between SAIT, Imperial, and IOSI, which stands for the Institute for Oil Sands Innovation. It is a project where we are testing and trying out the applications of UAVs for our mines so that we can gain a better understanding of the ore bodies, which can help us from a processing perspective, but also from an environmental perspective in the sense that it will generate less tailings.
The project at Curl is basically to use drones to kind of take people out of the mine, but still be able to get data from the mine face. So there's quite a bit of slope to the mine, and essentially what they want to do is to be able to provide data to their geologists that hopefully allows them to visually find different deposits of bitumen in the layers of rock without actually having to send somebody down into the mine. So we use the drones to take the pictures from safe distance, and we stitch those pictures together to a nice model, provide that model to their geologists so that they can look at the mine layers from the comfort of their desk.
Working with the students and employees from SAIT has taught me some great things about the new technologies out there. Remote sensing, drone technology, and future development opportunities with this technology is extremely exciting. What we can do with it here at Curl and how we can apply it to enhance the business.
The collaboration between SAIT and Imperial at Curl is very unique and provides us with with a different take on the way that we've done things before. Developing new technologies to deploy on the site is a very challenging endeavor for us to take on. Working with the Cirrus team really allows us to tap into a broader knowledge set that helps us accelerate our technology development and deployment.
I think the main success factor of this project from our perspective is integrating SAIT graduate into the advanced cutting-edge technology research. And second, integrate the new technologies and new knowledge into operation of the industry partners such as Imperial. And next step for us, we are going beyond the limitation of the knowledge that we have. We are expanding our knowledge. We are expecting to integrate much bigger devices such as Switchstrom, much better sensors for data capturing, and minimize the data capturing process and the processing as well to 1/3 or 1/5 in next phases. This partnership is a great opportunity. I think me and my team are so proud of it. And we think that opened up the great opportunity for us to get to know the real challenges in the industry and use our knowledge to be part of the industry to improve the outcome and the benefit to society.
All right, so I'm going to spend the next 30 minutes or so talking about the downstream and chemical as you're taking your seats. Okay, I think as you well know, we have a highly integrated downstream from refining through distribution on through to marketing. We have crude runs of about 400,000 barrels a day at our 3 refineries. We sell about 500,000 barrels a day in petroleum products through both our commercial and retail sales channels. That includes selling product through nearly 2,300 branded service stations. We have the largest overall market sales in Canada, and we have the #1 share in retail. Looking at our throughput and sales over time, you can see we optimized our refining network in late 2013 when we converted our Dartmouth refinery out east into a terminal. Now we have 3 strategically located and competitive refineries. You see them listed down the side: Strathcona in Alberta and Sarnia and Nanticoke in Ontario, as well as Coast to Coast Fuels Marketing. And despite our lower crude runs from the Dartmouth terminal conversion, we still have higher sales, and we made a conscious decision to oversell to continue to pursue high value sales and keep our refineries full. So looking at this chart, you can see we've had strong and resilient cash flow over time. You can see, one of the advantages we have in Canada, as I think you're all very well aware, is we get discounted crude. I've put the Brent and MSW prices down along the bottom. Our product prices are generally driven off of Brent, and we generally buy a local crude, MSW or heavies. And you can see, back when that spread was $14 in the 11 to 17 time frame, our downstream was generating over $1.5 billion of cash a year, about $1.6 billion. 18 was a unique year. That spread widened out. There were some other events that we all remember, and we were actually closer to $3 billion. But looking to this year, when the spread is back to about $13, we're generating a strong cash flow year to date. There's some working capital effects in there, but still strong cash flow in our downstream business. And what we're trying to do, as the subheading says, is we're trying to strengthen over time the capacity of this business to generate cash over a range of market conditions. And I'll talk more about some of those, but we're focused on enhancing our slate of crude going in, enhancing the yield going out, and making sure we have the logistics to support our growing high value sales. So looking at our refinery operations, this is an area where we benefit tremendously from being part of the global ExxonMobil network. ExxonMobil has 20-odd refineries around the world. We have, in our 3 refineries, we have a coker, a hydrocracker, a number of cat crackers. They have dozens of these pieces of equipment around the world. And there are networks tied to each piece of equipment, how to optimize that, the best way to do maintenance, what are the best practices. And so we punch above our weight in this space, leveraging that broader network. And you can see it in the chart here, which shows the Solomon benchmarking data. This is roughly 100 North American refineries, and this shows the Canadian-based ones. You can see the average Canadian refinery is in the first quartile in net cash margin in North America, given those locational advantages I talked about. But look across the other attributes, you can see we're well ahead of our Canadian peers. We're relatively weaker in energy. Obviously, energy is relatively cheap, natural gas in Canada, so it's not as much of a competitive issue as it might be in a place like Europe. But nonetheless, we've been progressing, as you know, our Strathcona cogeneration project, which will come on about a year from now, which will increase our energy efficiency, reduce our OPEX there, and obviously lower our GHG emissions, and move us up, if not into that first quartile, in that direction. Now, looking at our refinery footprint, I'll just take a minute to kind of orient you to this chart. We have West Canada and East Canada in those 2 sets of bars. West Canada is our Strathcona refinery, just under 200,000 barrels a day. East Canada on the right is both Sarnia and Nanticoke, which are quite integrated, and we kind of run together. And for the west and the east, there's two sets of bars. The left set of bars in the bluish colors are our crude runs, kind of typical crude runs. And the right bar next to that is the product output of the refineries in the west and in the east, our refineries specifically. So starting on the west side with Strathcona, clearly it's well located. Alberta is a very good place to find advantaged and discounted crudes. And you can see what we run. We run Cold Lake, which is our own equity Cold Lake crude. It's a very good crude for asphalt, and that's what we do with it at Strathcona. We then run about 50% Canadian Lights, MSW, and the remainder is synthetic crude from the Syncrude asset that John talked about. Now, we're continuously upgrading our capability. At Strathcona, we're just in the process this month of completing an expansion of our asphalt production by about 25%. We're also looking at finer cut points in our units to produce relatively more diesel and jet. We're looking at crude flexibility projects as we bring crude in, the ability to shift it between our two pipe stills, and of course the cogeneration project to increase the capability of this asset to generate cash. Now, when you look at the products produced there in the west, a lot of them go to the prairies. We have very good infrastructure. The Enbridge system out through Saskatchewan and Manitoba. We are pipeline connected from Edmonton down to Calgary with the Alberta Products Pipeline, which we're in the process of upgrading, and that new pipe should start up here in the first quarter. We also send an awful lot of product. About 15 or 20% of the product that's produced at Strathcona actually goes out to BC. We send a lot of MoGas out on TMX. We send a lot of jet out to the Vancouver airport, and we also move heavy fuel oil to support our bunker business out in Vancouver. So moving to the east, clearly we're connected to the Enbridge system through lines 5 and line 78. We can also get Bakken crudes that come into the Enbridge main line through line 81. So we have access again, very well located relative to advantaged crudes. And if you just kind of I'll walk you up the crude side on the east. We run Cold Lake crude again for making asphalt. That's our equity crude. We do that at Nanticoke. We run other heavies. And those can be Curl, equity or non-equity crudes. It depends on the economics. And as John noted, we run between the two refineries between 60 and 100 kbd of heavies, really driven by those spreads. But typically, the wedge here is about what we run. Another 50% of our Ontario throughput is Canadian Lights, and then the rest of it we bring in Bakken, some synthetic crude, depending on the economics. Now, we have half the capacity roughly in Ontario on a refining basis, and clearly we're very well located right next to the large and growing Toronto market. And we're well positioned logistically to move fuels there to the airport, to our Finch terminal in Toronto. We're spending about $385 million to upgrade the Sarnia Products Pipeline, which runs from Sarnia to our Finch terminal in Toronto. So very well positioned, discounted crude, access to a large and growing market. We're also continuing to enhance our capability to generate cash in Ontario from our refineries in Nanticoke. We're also expanding our asphalt production in 2020. We're looking to add a couple of KBD, mainly from running more constantly through the year and storing a bit in the winter for sales in the summer. Coming out of our Sarnia turnaround earlier this year, we replaced our catalyst in the hydrocracker. We're seeing higher distillate yields. We're looking at the metallurgy. We're always looking at that to see if we can take higher acid crudes in, so-called high TAN crudes. We're also at Sarnia looking at our tank configuration, adding some crude tanks to give us more crude flexibility. So, in summary, we have well-located refining assets in terms of access to advantaged crude, in terms of great connectivity to growing markets, and we're continuously working to improve their ability to generate cash. And a lot of this, we leverage ExxonMobil, as I said, with all their global expertise, and we can punch above our weight and really tweak, and get the most out of these facilities. Looking at our sales sort of overall and talking about our strategy, you can see hopefully some household names there on the left. Our sales strategy is really to build strategic relationships and grow profitable term sales, ratable sales, and we not only are term sales more profitable for us, but they allow us to run our network more consistently and keep our refineries full. And clearly it's about capturing brand value, particularly on the retail side. Among the folks that you see on the left, you have Couche-Tard, Parkland, 7-Eleven. Those are major branded wholesalers who do retail on our behalf. And I'll talk a little bit more about that. But clearly it's about optimizing the integrated profit, keeping the refineries full, getting high value term sales, where it's just not about growing sales, it's about growing the quality of the sales. Term, higher profitable sales, reducing spot sales, and growing sales to strategic customers on a term basis. And you can see some of the numerics around our position in the marketplace. We are the #1 marketer in the country. We're the market leader in most segments, as you can see. MoGas, 30%. #1 jet, 26%. #1 asphalt, about a third of the market, and quite a strong position in diesel as well. And as I said, we not only make profit on our own right with these sales, but we get the integrated profit of keeping our refineries full. I'll try and stop hitting the mic. Moving to a good example, it's a growing segment, the aviation segment, and it's a good example of high value, ratable sales. We leverage our production capability, our logistics, and our strategic relationships to win in this business. You can see the demand growth is sort of plotted there for the industry historically and going forward. Strong growth and expect to continue. In recent years, we've grown at a pace higher than the industry. We have over 50% of the Ontario market. We're growing our share in Vancouver. We're sending those Strathcona barrels out to Vancouver, as I mentioned earlier. Also, our relationship with ExxonMobil gives us advantage access to global airlines. And bottom line, this is attractive business for us on an integrated earnings basis. We're participating in this growing market. And again, this is building our ability over time to generate strong cash flow in the downstream part of our business. Another good example of a commercial sale that we do on a term basis is asphalt. Asphalt's a growing market. It goes into roads and roofing. You can see that the trend there in our production, matching the growing demand. We make asphalt, as I mentioned, at Nanticoke and at Strathcona. In Nanticoke, it's really a local market. We truck it to the local area. But in Strathcona, with our advantage Cold Lake blend and our strong rail logistics and strong connectivity to CN and CP, we're actually competitive in pushing asphalt actually throughout the U.S. A lot of it goes to the Pacific Northwest and the West Coast, but we sell it in the Plains, the Midwest, down into Texas. And as I noted earlier, we're growing our volumes here, both at Nanticoke by a couple of KBD at about 25% at Sarnia. And again, strong, growing business. We're growing our market share, have strong logistics, advantage feedstock, and we're growing our capacity to generate cash over time. Moving to retail, which is our highest value channel, we continue to see strong growth. I really like the slope of this chart. It's very pleasing, at least to my eye. We've maintained our #1 market share, which we talked about a year ago. We've actually widened that a bit in retail. And you can see that the strong volume growth in the bars. It's over 10% a year over the period shown. We've also grown our number of service stations, as I mentioned earlier. We have nearly 2,300 service stations as we speak. So the question is, how do we get to this spot and how are we going to continue growing? Part of it's leveraging the broader ExxonMobil technology and network, ExxonMobil has some 20,000 branded sites worldwide, so we leverage the strong brands, Esso and Mobil. We leverage, the Synergy fuel technology. We rolled that out a few years ago. It's a very high quality ad pack that gives better mileage, lower emissions, as well as increased engine responsiveness. That was developed by ExxonMobil globally. Again, leveraging that kind of thing allows us to punch above our weight. We also have convenience. We have our Speed Pass Plus app. And you guys, I hope you've all downloaded. If you don't, we can help you just after this. But this app on your phone, you can put your credit card in there, you can put your loyalty, and you don't have to get out of your car and fumble with your credit card. I've heard it gets kind of cold in Canada in the winter, so it's really a good feature. I encourage you all to leverage that. Absolutely. I don't want to comment on our competitors' products, but just buy ours. It's safer. That's all I'm saying. And, but it's another great example of ExxonMobil developed that we get to leverage it. Now, another really important part of retailing is loyalty, and loyalty is more local. About half of our retail sales have a loyalty component, and the bulk of those is the PC Optimum program. It is a very large loyalty program in Canada. We joined it about a year ago. 70% of Canadian households have a PC Optimum card, and it's really been a key part of our offer, and we've seen that's been part of our growth. So we have a strong offer. We have the high-quality products, the Synergy technology, strong brand, strong loyalty, and what this obviously does is it attracts the consumer. All of you guys who are buying gas at our stations. And when you have a strong offer, then that attracts strong branded wholesalers, strategic partners like Couche-Tard, 7-Eleven, Parkland. It attracts them to want to work with us to put our flag on their sites. And over the course of this year, we've added nearly 100 sites. Our branded wholesalers have paid for and built, almost 100 sites. So that's what the model is all about. You have to have the strong offer to attract the branded wholesaler to grow this business. And you can see we're on a really quite a strong growth trajectory, consistent with our sales strategy. We're building the strategic relationships, growing ratable sales. Retail sales are generally quite ratable. We're capturing the value of the brand and the offer, and we're optimizing that integrated profit from the refinery on through. And over time, as I've said, this is part of strengthening the fundamental ability of our business to generate cash over a range of economic sets of conditions. So next, I'll shift gears just a little bit and talk about IMO 2020. And I always have to say IMO is not Imperial's ticker here, but the International Maritime Organization. We've talked a lot about this. We talked about it last year. It's almost upon us, right? January 1st. The world hasn't ended, best I can tell. I don't expect it will on January 1 either. Though we have seen heavy crude differentials have a lot of noise in them, obviously with Venezuela and the recent Keystone outage, which thankfully is back on. But clearly they're widening out a little bit in reaction to the IMO 2020 as folks expected. Distillate cracks have also strengthened. Recently, those cracks on a seasonal basis have been above their 5-year averages. So we're seeing kind of the effects we thought about. And clearly, as an integrated entity, it reduces the impacts on Imperial. We may see some pressure in the upstream, but some benefits in the downstream. So for us, not a significant issue. And one of the things we're doing, it's going to be a multi-product world in marine. It's not just going to the 0.5%. Obviously, as folks know, a lot of people are installing scrubbers, so there's still demand for 3.5 as well as the 0.5. We're going to actually offer 4 grades at our IOCO terminal in Vancouver, the 3.5 for the folks with scrubbers, the 0.5, the new compliance standard, 0.1, which many of you know within a couple hundred miles of the coast, you need to have even a lower standard. That's been in place, I think, since 2015, so-called ECA, Emission Control Area. And a 4th will sell a blend stock to shippers so they can blend to their own particular desired sulfur spec. So we're taking advantage of the opportunity. So there's adaptation in the market. I talked about the scrubbers. Refiners will adapt, as you all know, in ways big and small. It could be small stuff, cut points, and small optimizations to make less heavy fuel oil, or bigger things like resid destruction through cokers and the like. So we don't see this as a major issue for Imperial. and we think the industry, as some of you have written about, will adapt successfully over the next year or so. So summarizing the downstream, we have high-performing refineries. They leverage, they benefit tremendously from leveraging the broader ExxonMobil network of best practices, skill, technology. We're well located, as I said, near advantaged crudes, near large and growing markets, which we're well connected to. We have market-leading scale and integration. We have strong brands and loyalty we're using to really build up our retail business. We're pursuing high-value sales growth, retail, commercial sales on a term basis with key customers. And we've had robust cash flow and expect that to continue going forward as we continue to look at slate projects that give us more flexible, cheaper crude slates, higher yields. We're going to continue to focus on growing higher value sales, making sure we have the logistics to support that growth, and making our business stronger and increasing its capacity to generate cash over time. Now I'll talk about the chemical business. We are well located. Our chemical manufacturing facility at Sarnia, which is integrated with our refining facility. So not only does it get the operational integration, which is valuable, but it gives us access to refinery off-gas, which is a very cheap source of feedstock. We're near the Marcellus. We have access to the Marcellus ethane. We're also near our customers. The bulk of our customers are within a day's drive. And lastly, again, ExxonMobil has a huge chemical business, a huge polyethylene business, and we have access to their best practices, their technology, their technical support to run those plants well and to provide the sorts of products our customers want. Polyethylene that we produce is a specialty product tailored to individual customer needs. It's not entirely a commodity. And you can see the numerics there. We make about 800 KTA of product. About half of that's polyethylene, and that is where we make the bulk of our money. And our customers make all kinds of cool things with the stuff we sell them that we use in everyday life. And I just want to note again that it's really not all polyethylene is not the same. We work with our customers. They have different requirements for ability to resist temperature change, UV resistance, flexibility or plasticity, what kind of dye the plastic can absorb, and we tailor that to their specific needs, which leveraging ExxonMobil's network, and our Sarnia folks are really well known for their technology support, their customer support. While we're still subject to global polyethylene margins, we have an advantage in this area. And you can see here, graphically, we've shown the feed, the refinery off-gas, and the advantaged Marcellus ethane as well. You can see our cash flows over time. Going back to the down years, we were still making, we show 9 through 12 here, we were still making 80 million-ish of cash flow in this business on average. Then we had the really good years where we're making, almost on average pushing to about 270 million. So pushing 300 million, very strong for a number of years. Now it's coming down a bit, still quite strong this year. But as all the capacity in the Gulf Coast has come on, we're definitely seeing weaker polyethylene margins, and we expect that to continue for some time. But given our synergies with the refinery, our advantage feed, our specialty products, we see this as continuing to be a profitable business even through a chemical down cycle. Okay, kind of bringing it all together and just talking about the value chain, from crude, the things that John talked about, all the way through logistics, refining, all the way through to the final customer. We were integrated across that value chain. And that gives us the opportunity to leverage opportunities all along that value chain. It also gives us financial resilience. As we can see, IMO 2020 is a great example. May hurt the upstream, but we win in the downstream. The crude disconnects we saw last year were another great example. The chemical cycles, another example that could be a little bit counter-cyclical. So we have a resiliency that comes with that integration. And we have the balance sheet strength. So we have optionality to invest all along that value chain. And almost at each point, if we choose to invest, we can punch above our weight because we have ExxonMobil's global expertise and scale and technology and best practices, et cetera, behind us. So with that, let me turn it back to Rich. Don't hit the mic, Rich.
Don't hit the mic or stomp my feet. Okay, what does it all mean, delivering value? We've shown you kind of business line by business line, the cash flow contributions over time. Thought I'd put it all here together. This is the corporate, the last 9 full years, and then through the third quarter of this year. What you see as you look at it, you see the split upstream and downstream, which over a 10-year period is essentially 50-50, right down the middle in terms of the contribution to our operation. It's about $33 billion over this time period. And over this time period, you can see we've had high annual years of about $4.5 billion, lows of about $2.5 billion. We've seen oil prices over this as high as $95 to approaching $100 a barrel WTI, and we've seen lows in the mid to high $40 a barrel WTI. My message here is that we are designed and built to generate cash and deliver value through upstream, downstream balance and integration in most any business environment, designed and built for it. I want to take you a step further and give you a little bit more of an analysis over this. If you look at the periods here, each of these bars are annual cash flow from operation for discrete periods of time. The first period, 2012 through 14, we had WTI that averaged $95 a barrel during those 3 years, WCS at 73. We then went into a downturn 2015 through 2017, where WTI essentially fell in half, averaging $48 a barrel. WCS at more than half at $34 a barrel, and you can see our corresponding reduction in cash then. But I really want to draw your attention to 18 and 19. We've had WTI at $61 a barrel, more than $30 off that earlier peak period, and we've had WCS at 42, again more than $30 a barrel off that earlier period. But look at the cash gen. 18 and 19, we're not quite done on 19, so I've projected here a bit. We're going to average about $4 billion each of the last 2 years in a price environment that's $30 a barrel lower than we've delivered $4 billion each year in the past. So how are we doing that? Well, you heard the story today. In the upstream, it's about growth at Kearl. It's also about reliability at Syncrude. In the oil sands, size matters, so that scale at Kearl is continuing to drive down unit costs. John Whalen outlined how we're going to continue to do that in the years ahead, starting in 2020 with the supplemental crusher. And in the downstream, Dan highlighted how on the refinery side we made a strategic decision 7 years ago to sell beyond our manufacturing capacity, even as we shut down our Dartmouth refinery. And he went brand by brand, product by product, and talked about how when we have a branded sale, and it's a ratable sale to strategic customers, that we get more value for those sales. So the refining operations side of it, the marketing aspect of it, in a much lower environment, we are generating cash that would have previously taken a price environment some $30 a barrel higher than we're in today. These are all actions from within, not actions that rely on or require oil price growth, but things we keep doing internally, whether that's application of technologies, whether that's application of digital initiatives, whether that's just the hardcore base running of our operations, our facilities, to generate more and more cash without a major growth initiative and major capital spending. I think this analysis is something that we will continue to help the market understand. What are we doing to help ourselves no matter what environment we find ourselves in? Okay, a few things. I want to run through a few slides here pretty quickly. Financial strength, you've seen this before. What's shown is debt to capital, us versus our peers. Capital allocation priorities, maintain a strong balance sheet. We've talked about this in the past with a debt to capital ratio of about 17%. We're doing that. reliable and growing dividend, invest in high-valued projects, and then if and when we have surplus cash, returning it to shareholders via buybacks. Gives us a lot of flexibility, a lot of optionality. Several of the companies that you represent here in this room, I get regular phone calls on asking if we're interested in borrowing money. That is not our issue. Dividends, long-standing priority, reliable and growing. If reliable, what that means is more than 100 years of consecutive dividend payments. This year now marks the 25th year-on-year growth, 10.3% 5-year compounded rate. We've increased it earlier this year. And as I've told Brad, Lord help any future CEOs who would break this trend. Share buybacks, history, returning surplus cash to shareholders. If I charted this back to 1995, we've bought back more than half of our shares over that period. We went through a major upstream growth period with Kearl and Nabier earlier in the decade, where we largely suspended buybacks. We reinstated those buybacks in 2017, as we said we would. Since then, we've bought back nearly 100 million shares, about $3.7 billion, and consistent with our priority on shareholder value, shareholder returns. And you've seen it here, I show 17, 18, and 19 from a share basis, the number of shares we've bought back each year. I've said in the past that we would not have reinstituted this buyback program if we didn't think we would be able to sustain it for some period of time, and I stand by that comment today. Shareholder distributions, we've added up both dividends and buybacks over the period relative to the peers, and this is in terms of a payout ratio, both, again, the dividends and buybacks divided by the cash flow, and you can see over this period, kind of year in, year out, over the course, we've averaged just shy of about 30% in terms of our payouts to shareholders. Okay, near-term outlook. Giving you more than we typically have. A little bit kind of a 5-year outlook, including this year on the upstream and on the refinery throughput. Indicative at this stage, as we get a little longer out there, 2019, both on our third quarter earnings call and then through discussion today, we've largely focused in on what we expect in terms of volumes in the upstream and refining throughput. 2020, John gave a bit of an outline and wrapped it up with what we expect on the upstream side. In the refining side, we're still refining the kind of the estimate on it. We've commented how we'll have fewer turnarounds next year. That will be, this year was a particularly heavy year on turnarounds, so you'd expect refined volumes to be higher. And then as you look beyond that, we'll see continued upstream growth, largely due to continued efforts to increase Kearl from the 240,000 barrels a day to the 280 that John detailed. And then over the next few years, we would expect a comparable level of volumes through on the refinery throughput, again, dependent any particular year based on turnaround activity. CapEx. The 5-year outlook shown here is consistent with our previous communications to you. We have sustaining capital requirements that on average are about $1 billion to 1.1 a year. Some years a little higher, some years a little lower. That's the range we've talked about in the past. That hasn't changed. Roughly 70% of that, or about $5 a barrel, are associated with our upstream assets. Again, a little bit of a variation from asset to asset, but on average about $5 a barrel. For this period, we have growth capital between $700 and $800 million a year. It'll be focused in areas that were highlighted today: Coal Lake, Grand Rapids, the conversion from the Coal Lake expansion project to the Grand Rapids development, and monies associated with the Kearl pathway to 280,000 barrels a day. In the downstream, we're making some logistical investments in strengthening terminals and pipeline operations, refining efficiency. What I should note in these, just for clarity, we don't have Aspen expenditures detailed in these bars because, as John outlined, Aspen timing is to be determined. You'll recall in the past I've talked about when we're executing Aspen, we'll have peak expenditures in the $700 to $800 million a year range for about a 3-year period. So when folks can help tell me when curtailment will be eliminated, when rail will be back in the money, when we'll see progress on pipeline egress. I can plop Aspen on this chart, and you'll see those kind of expenditures. So we've taken it out just to help you see a little bit of early guidance. 2019, we've said throughout the year we expect somewhere between 1.8 and 1.9 billion capital expenditures. You know, we're rapidly closing out the year. That's where that range is where we'll end up. In 2020, we typically give guidance in the late January time periods. You're getting a bonus today, so we look at it somewhere between 1.6 and 1.7 billion. That's lower for 2020 than we would have shown a year ago, primarily due to Aspen. That's the biggest difference if you pulled out last year's package and compared the 2 years. So kind of year on year, when I say consistent with, the biggest difference is the timing on Aspen, the substitution of Cold Lake Grand Rapids for what was previously the expansion project at Cold Lake, and then just some of the timing and magnitude of downstream logistics. Those are the primary differences, but no real material change year on year. Let's put it all together and look at what it says about financial strength. On the left bar is cash flow from operations at a range of prices. Prices are shown in the middle. We've used WTI as indicative. And then on the right are our uses of cash, and they're also summarized in the table to the right, where dividend at current rate is round numbers, about $600 million a year. I've commented on the sustaining capital and the growth capital. The subtotal there, 2.5 billion in terms of their priority needs. In a $40 a barrel price world, we can generate the cash to meet those priority needs. This, if you go back and you hold us accountable for the last several years and you've looked at this deck, what you've seen is that break even drop down year on year, driven by those things I've just articulated a moment ago on what has increased our cash level as we've strengthened the business from within, providing a level of resiliency and flexibility in whatever world we happen to live in. Beyond that $40 a barrel, that's where there's that surplus cash, whether that will be to support the buyback program that I've talked about or to invest in high quality projects or whatever opportunities we see for continued growth. Resiliency and strength over a wide range of prices. Right there, now, I'm going to turn it over to Brad, who will offer a few closing comments before we continue into the Q&A.
Well, good morning, everyone. It's certainly great to be here today and have the opportunity to speak to each of you. I've had the chance to introduce myself personally to many of you, but I hope before we finish up today that I have the chance to meet all of you. I think having an ongoing dialogue between us is very important as we go forward, and I'm committed to that. As you know, I'm the new guy here. I'm new to Imperial. Having said that, I have a long career in the industry. I spent 36 years with ExxonMobil in a wide range of assignments, including production assignments, commercial assignments, major project assignments. Also worked in the downstream in supply and trading. Also spent a little bit of time in human resources and in career design, career modeling. So a very wide range of experiences. Both in the U.S., but also living overseas in Hong Kong and in the U.K. And I've done business in probably 30 or so countries around the world. Having said that, I'm a bit of a novice to Canada, and I'll be the first to admit that. But I'm super excited about immersing myself in this country, immersing myself in the business that's Imperial. And I've already started that, and I'm super excited about what I see. Imperial's a great company, has a great future, and has a great brand, a great image. and I'm just proud to be a part of it. So I'm already spending time with Rich and the leadership team, learning more and more about this great company, the strategies that are in place, the business plans, many of which you've heard about today. You know, Rich and I have known each other for almost 30 years now. And certainly that is an enabler for the transition. Not only are we colleagues in the business, but we're personal friends. And certainly that helps as you're trying to transition a very key role like the CEO role. And so over the past few weeks, I've spent a lot of time in Calgary, but also starting to visit some of the operating sites around the country. Super excited about meeting the many people of Imperial. The experience I've had engaging them, their enthusiasm about the business, their commitment about the business, their mindset around innovation and entrepreneurial approaches is just truly inspiring to me. And it gives me a lot of pride to know that I'm going to be leading an organization that has such a bright future ahead of us. So as we close out the session, I've got just one slide that is going to really just summarize what we've been talking about so far this morning. That started with Rich really talking about you know, the importance of our industry in society today, the role we play in meeting the global energy demand and improving the quality of life of people around the world. And then talking about the advantages that Canada brings to helping meet those needs. And then obviously a lot of time about the role Imperial plays in that equation as well. And so, you know, I've summarized here what I consider 7 key attributes that distinguish Imperial, help drive us to why Imperial is so important. And it starts with this long history in Canada. And many of you that are from here, you may know this and appreciate this better than me. But it's been really, like I said before, it's been inspiring to learn about the long history that Imperial has that dates back to 1880 in this country, when Imperial was formed by 16 oil refiners in Ontario, close to here. And that started the journey that brings us to where we are today. So that history, think about it, this company is almost as old as the country Canada. And so, you know, through that long history together, Imperial has become, if you will, integral to society here. We're part of the fabric that is Canada today. Imperial has had so much impact on people in this country that, again, it makes me very proud, as it does, I know, our employees. We have a long history of firsts. Some of those have already been mentioned, but we talk about the first kind of research center for the industry in the country. We talk about the first service station in the country in Vancouver. We talk about the discovery of oil in Alberta with the Leduc well. And those firsts just go on, and we continue to contribute to those today. We have nearly 6,000 employees that work for Imperial, and many more contractors, many more business partners. And they're all working to meet society's needs for energy. And in Canada, obviously contributing quite significantly to the economy here. And when I step back and I just think about how many people rely on Imperial, you know, Dan talked about kind of our retail brand and the market share we have. Every day people are being impacted by Imperial, whether it's, you know, through filling up their car with gasoline, whether it's driving on roads that were paved with asphalt from our refineries, whether it's flying around the country, around the world with aviation fuel. All of those are impacting society. We talked about the specialty polyethylene products that we use in everyday life. And then beyond that, you know, things like hockey and the history that we have in supporting hockey in this country. No matter where you look, we're a part of that fabric. And that's pretty exciting. Now, obviously, we talked a lot about the asset portfolio, and that's key to generating cash and profitability. John talked about, you know, the 3 core assets we have with Cold Lake and Syncrude and Kearl. And there's a positive story and a positive path for each of those. They're all very long life, low decline, and they're going to be here for decades to come. And we're going to continue to apply technology to make them better, make them more profitable, more efficient, and also reduce the environmental footprint. Kearl is just a great story, and I get more and more enthused every time I hear about kind of the journey we've been on, where we are today, delivering on commitments, currently producing approximately 200,000 barrels a day this year. The work we've done with the supplemental crushers that will begin starting up the end of this year to bring us to 240, and then a pathway to 280 as John described. And all of that's going to allow us to drive down those unit operating costs to $20 a barrel. And this continues to be a very, very large cash generator for us going forward. And then, of course, we have other opportunities within our portfolio, a deep inventory of in situ opportunities that John described, including Aspen. And as we discussed, although today is not the right time to progress those opportunities, that time will come, and we'll be ready for that. We've got the financial strength, we've got the technical capabilities that we can move those forward when it makes sense for us as a company. We talked a lot about the advantage downstream assets and the strong ongoing performance of those facilities, really world-class performance, as Dan illustrated in one of his charts. And what's really exciting there is just how well integrated we are with 3 top refineries, an integrated chemical plant with one of those, you know, great slate of products that we're supplying coast to coast. And then overlay on that the chemicals business. So really a strong portfolio that's going to continue to generate significant cash for us. And then we increase even greater value through the synergies of having the upstream assets, the downstream assets, the retail network, a strong logistics network to support all of that, integrated transportation, and that just allows us to create even more value from the totality of that portfolio than we could from any individual asset. And then we overlay on that the additional capabilities and strengths that we can draw on from our majority shareholder, ExxonMobil, And that just makes us a powerhouse that is able to compete in a wide range of price environments, makes us very resilient, and allows us to consistently deliver very strong cash flows. We've got this unparalleled history of creating value through technology and innovation as well. We talked about that in both segments of our business. And those technologies have not only enabled greater efficiency and production rates, but they also have allowed us to improve our environmental footprint, which is hugely important as we go forward. We have industry-leading ESG performance. Rich spent some time talking about that, and rightly so, given its priority to society today. Imperial has delivered very strong results in that area, and we are committed to even further progress and results in those areas. And so lastly, what does all that mean? Collectively, you bring all these attributes together, and it's allowed us to consistently generate strong and resilient cash flows, allows us to invest in good opportunities while maintaining a very strong balance sheet, and at the same time return cash to our shareholders through a reliable and growing dividend, as well as share buybacks. As Rich said, over 100 years of dividend payments by this company, with 25 years of year-on-year growth as well. So that's a very strong track record of delivering shareholder value. And I can say we as Imperial are working hard every day to continue on that path, that track record, and I personally am committed to it as well. So as I bring this to a close, I hope our presentation today has given you good insights into our assets, our strategic objectives, our business plans, and excites you as much as it does me about the future for Imperial. So thank you for your attention, and I'm going to turn it over to Rich for the Q&A session.
Now it's your turn. We'll take your questions. So we'll look at all those hands. That was the first one here, so we'll go back there, and then we'll come to you, Mike. No, go ahead. Yeah. I think you may not need the mic for in the room, but I think it'll help for the people that are on the phone.
All right, thanks. Dennis Fong over at Canaccord Genuity. I just got two quick questions here. So the first is just around capital spending and kind of your, frankly, the methodology is how you think about spending it over the next few years. Obviously, you've outlined a kind of mid to low twos range without the Aspen project therein. How should we be thinking about your allocation of that excess free cash flow with respect to capital projects versus returning that cash back to shareholders? And I have a follow-up.
Okay. Well, I think that, first and foremost, I commented on the sustaining level of capital. That's a high priority. It's, we've got to take care of the, care and feed for the kids we have, and those are the assets in the upstream side, and that on any given year is that billion to 1.1 and stuff. So that's kind of a foundational layer. And above and beyond that, it's about value. And it'll be value if in the upstream, it can be continuing to enhance what we have, sustaining Coal Lake. It can be incrementally improving Kearl. The upstream will vary a bit more on market conditions for further growth, the Aspen things. So that'll be a bit more judicious and will depend on some things that are outside our control, market access, some of the other things. And the downstream, it's about spending monies to continue to strengthen and solidify what we already believe is a strong position in the refining and marketing sectors. Those things aren't they don't generate as much headlines. They may be improving refinery efficiency, certainly adding cogen at Strathcona, strengthening or replacing a pipeline that's near the end of its useful life, things like this. But those will be the priorities in the near term. when there's anything big, restarting Aspen, things like that, those would be the headlines. And so I think taking care of what we have, some selective high quality growth until we determine the time for, bigger, more material, particularly upstream growth investments occur.
Great, thanks. And then my second question here is just on the Curl project. So obviously being able to showcase over 200 or getting close to 280,000 KBD in Q3 of potentially 2020 on a go-forward basis. How should I be thinking about we'll call it how conservative you believe 240,000 barrels a day for a full year average happens to be, and what do you think the achievability of getting somewhere higher than 240, maybe not necessarily hitting 280 on an annual average basis happens to be as well?
I got to tell you, I've had nearly 7 years of standing up here and talking about Curl and in a whole bunch of meetings with you. And here we are near the end, and John gets to come up here and tell the good story about how we're resolving things and we're, on a confident track. I'm being facetious. It's been, we've had many long days, late hours working hard to get Curl where it is. And I think John's description was quite accurate, delivering on commitments. And that's exactly what we've been doing now since November of 17, when we had a conference call and we said, here's what we're doing, here's what we're going to deliver in 18, here's what we're going to deliver in 19, we're funding supplemental crusher, here's what we're going to deliver in 20 and 21. And if you go back to that date in November of 17, we have done exactly everything we've said we're going to do, and that gives me a real sense of confidence and pride going forward. So the 240 next year, we based it on, we've been advertising 240 since November of 17 based on the enhancements we were making and what we expected to add. A lot of confidence in the 240. Are we willing to say, numbers above that yet? I don't know, but we're very confident that the added reliability and the ability of the organization to learn so that as we have either scheduled or unscheduled maintenance, that we can use the facilities to the best. Do I expect that we'll be able to achieve better than 240 over the next few years? I think so. I don't know that it's time to make a commitment on that yet. I want to get the crushers up and running, see how they do, but I know we have an organization that when you give them good, strong, reliable facilities, they find ways to operate them better and better. And I think that's exactly what we're going to do. Dennis, you made the comment about third quarter next year, 280, really 240 for next year, and largely 21, and that pathway to 240 to 280 will be a several year journey that I'd really probably put it a few years out beyond that, and that'll come in smaller increments, not like the 40 with the supplemental crusher. That'll come in 5s and 10s over a several year period. Let's go to Mike, and then we'll come back over on each side here, 2 over here, 1 over here.
Thanks, Mike Dunn with GMP
Hi, Mike.
First Energy.
I know who you are.
The audience.
I know, it's people on the phone.
Rich, I've asked you about this, I think, in past investor days, but
does that mean I didn't answer it in the past?
No, it means you've given more detail this year. The Mildred Lake extension.